A report released today by ABN Amro has indicated that while there are some near-term upsides, in the longer term, oil prices are shifting downwards. On the phone with me now for the first Commodities Corner interview of the trading week is author of this report and energy economist Hans van Cleef. Hans, let's firstly discuss this. What are the drivers for your suggested price action?
Well, in the near term, oil prices could find some support as summer markets naturally goes hand in hand with lower liquidity. And this normally means that any positive signal from the market could be translated in adjusting expectations for future oil demand. But in these thin markets, some overreaction of these kind of moves is often seen, leading to increased volatility and thus some upside potential for oil prices. On the longer term, though, we see downward pressure to increase as we forecast a stronger US dollar, some unwinding of the stimulus measures by the Fed. This would result in higher yields. And we see some oil overproduction to continue. So overall, Brent oil prices could drop to, say, $90 per barrel in 2015 and WTI to $85 in 2015.
Talk us through the Brent-WTI spread at present. While energy traders were, prior to 2011, accustomed to WTI trading above Brent, you're now forecasting an end to this trend. Is that correct?
Yes, that's correct. Since 2011, Brent traded above WTI due to several reasons. This is including a risk premium on Brent as a result of the Arab Spring tensions, but also as a discount to WTI due to high local transportation costs. Well, ABN Amro believes that although some pipeline capacity became available in the U.S., transportation costs from Cushing, Oklahoma to the Gulf region remains high, as this is mainly done by rail. This would justify a discount to WTI crude, and furthermore, we see a rise in risk premium which will be continue to be added to Brent as long as the Middle East tensions continue. And of course, the main focus here is on the Iran nuclear situation. All in all, in our view, a spread of at least $2 to $5 with Brent trading above WTI should be expected for the coming years.
Geopolitical tensions continue to add what you have described as risk premium to oil prices. With unrest in the Middle East potentially threatening major oil producers, where else geographically does ABN Amro see opportunity? Sub-Saharan Africa, for example? Or are we jumping the gun on investor diversification away from the region?
The energy sector remains a good investment, and also oil will continue to play an important role within the total energy mix in the coming decade. With oil being traded globally, the impact of Middle East tension will be felt in almost all oil prices. So basically, a regional diversification for oil to avoid this risk premium, that's very difficult.
With so much tied into the USD at present, as you've mentioned, as we head towards the tapering threshold, how is a stronger dollar likely to impact energy prices in the coming months?
This will have a major impact. ABN Amro expects the US dollar to appreciate against the euro. In fact, we forecast euro-dollar to drop to 110 at the end of 2014. And if we take this, combined with the higher yields due to the Fed unwinding its stimulus measures, that would make commodities, including oil, less interesting for, at least from a speculative perspective. And these first effects already could be seen as soon as the market starts to price in these higher yields in the US, and that's probably in the course of 2014.
Many thanks, Hans. Want to know more about the Baltic economies? I'll be back shortly with an exclusive interview concentrating on Estonia, Latvia and Lithuania, so don't go away.